There is no doubt that the coronavirus continues to have a macroeconomic meltdown worldwide. In the United States and elsewhere, heavy job losses are likely to reduce unemployment to levels not seen since the Great Depression. Financial efforts to control the crisis deficits are the last World War II. Pushes to levels seen during World War II. Both developments led to fears and comments that the crisis turned into depression or a debt crisis. But is it too early for such pessimism? There is no intensity of this shock. The depth and speed of the drop in output is unique and frightening. Also, coronavirus will leave a structural macroeconomic heritage if economies do not fully return to their old growth paths or rates. But this is a long way from macroeconomic shock, even a severe shock, to a structural regime collapse such as depression or debt crisis. Price stability is the parameter to watch. This is the key to an appropriate macroeconomic regime. A break, such as depression or debt crisis, is marked by excessive deflation or a shift towards inflation, and thus disruption of the normal functioning of the economy. In the past 30 years, the United States economy has enjoyed low and stable inflation, leading to lower interest rates, longer business cycles, and higher asset values. However, if price stability deteriorates, it will have great consequences for real and financial economies. So, knowing that, how concerned should we be? 4 ways of structural regime break. Policy and policy stand between a serious crisis and a structural regime break. Insufficient, inadequate policy that cannot stop the negative trajectory of a crisis-free economy is political reluctance. We mapped 4 roads leading to a structural regime break using historical examples to illustrate each. First one, policy error. The first path to a depression occurs when politicians and policymakers struggle to diagnose and solve the problem conceptually. The Great Depression is a classic example, not just the death of the crisis, but an epic policy failure that facilitated its length and heritage. There were 2 conceptual misunderstandings: monetary policy error and banking crisis. Limited oversight of the banking system, tight monetary policy, and bank transactions resulted in thousands of bank failures and enormous losses to depositors between 1929 and 1933. The collapsed banking system prevented credit flows to firms and households. The Federal Reserve stopped when the banking system collapsed in 1913, believing that monetary policy was advancing easily, although it was apparently created by combat such crisis. In reality, it was stuck with a conceptual error, fiscal policy error, and austerity. Politicians also realized that the economy has been bleeding for a very long time. The New Deal came too late to prevent depression and was too little to reverse its effect. When fiscal policy tightened again in 1937 and 38, the economy collapsed again. Finally, World War II has resultantly ended the Great Depression by increasing aggregate demand and even returning economic output to its pre-depression trend. The consequence of these policy errors was a serious deflation, price level slump of over 20%. This while unemployment was at a very high level, while the nominal value of many assets fell sharply. The real burden of most debt sharply increased, helping households and firms struggle to regain their basics. Number 2, political willingness. The second path from a deep crisis to depression, economic diagnosis, is clear and remedies are known, but politicians remain on the road to solution. It's a question of willingness rather than understanding and mentality. There is no need to look far to show this risk. A political shortcomings will dangerously drag the United States economy into a deflationary depression in 2008, when the United States Congress cannot agree on a way forward in the global financial crisis. Towards the end of 2008, bank capital losses accumulated, leading to a credit crisis that broke the economy. With a weak banking system, the road risk to a deflationary depression was real, as highlighted the collapse expectations deep in the crisis expectations. The most dangerous moment came on September 29, 2008, when the House of Representatives voted down TARP, the $700 billion rescue package to recapitalize or bail out banks. The ensuing market collapse helped change the political price of standing TARP's way, and a few days later, on October the 3rd, the bill was passed. Effectively, political willing met at the last minute to prevent the structural regime from breaking and put the structural heritage in a U-shaped shock. While the United States economy regained its growth rate a few years later, it could not find a return to the pre-crisis growth path, which is the definition of U-shaped shock. Number 3. Policy addiction. A third potential way from severe crisis to depression is that policymakers do not have functional autonomy, authority, or financial resources to act. This happens in countries or regions lacking monetary domination or in central banks' autonomy. In other words, in times of crisis, they cannot use the central bank to maintain a healthy credit flow, even if the currency is stable. Internal depression, price and wage deflation is the only way for these economies to rebalance and meet the constraints of monetary dependence. Perhaps the best example of such an addiction is Greece's relationship with the European Central Bank in the context of the global financial crisis. Unable to use the ECB for access to finance, Greece had to undergo a depression that came with severe deflationary pressures. Number 4. Policy refusal. The fourth way differs from the previous three in that it led to a debt crisis rather than a depression. In this case, policymakers know what to do. They have political will, but because markets reject their actions, they cannot increase real resources to do anything. This is different from the other three ways because it leads to high inflation instead of deflation. Think of Argentina. At various points over time, the Asian financial crisis of 1997, the Latin American debt crisis of the 1980s, and more Weimar Germany. In all of these examples, policymakers were unable to collect real resources for financing because the debt and foreign exchange markets refused this. Looking at the risks of debt crisis, commentators often engage in debt levels, but this is a misunderstanding of debt crisis. They happen at all levels of debt to GDP, and they don't. Connected inflation expectations, negative risk rate correlations. When risk increases, rate decrease. The global demand for the currency in question and the difference between nominal interest and growth rates all affect the financing ability of an economy more than debt GDP ratio. Why the USA is low on structural regime break, while the path from the current crisis to the depression or debt crisis is not impossible. If we examine each of the four ways about the current situation, it is not easy or natural. So, why do we see fear of breaks? We think at least part of the response is the extreme intensity of coronavirus shock. The depth and speed of output contraction threatens to influence perceptions and risk assessment of this heritage, such as the structural heritage form of recovery and the risks of structural regime breakage. While these fears are understandable, analytical errors from them can have significant consequences for setting false expectations and promoting inappropriate plans. Several principles of intellectual discipline can help leaders avoid these analytical traps. Beware implicit and explicit equivalences to historical events. If describing the future, be aware of historical benchmarks. Meanwhile, if using historical benchmarks, be aware of their drivers and relevance to the present day. Beware of single data points and the inferences that can be drawn from them. Is there passing resemblance or casual equivalence? Record outcomes in any dataset always make great headlines, particularly in financial and economic reports, but the overall context determines their true significance. Step back when fear is dominating the thought process and when extrapolating from high-intensity events. Even the worst ever in one dimension doesn't mean the worst along all dimensions. Be cognizant of what these scenarios imply. A depression-driven regime break also means large-scale deflation. A debt crisis regime break also means a weak currency and high inflation. Are these corollary conditions consistent, and do they fit the facts? Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is wise to consult an expert before making this decision.